Okay, so let's move on to the topic Dan has here, which is economists are predicting. This is a client question that we've paraphrased, but it's a great question, and Dan's got a great answer. Economists are predicting more rate cuts in the near future. Should we switch into longer term bonds to take advantage of falling interest rates?
Yeah, and it is a really good question. It's one that we get a lot. And I can remember, years ago when we were in the opposite situation where everybody expected interest rates to rise, we got the inverse question, which is again perfectly reasonable. So let's, start by, acknowledging that central banks do sometimes telegraph their next moves, right? I mean, they try to keep tight-lipped, but I think we can all agree that, the consensus is the next few interest rate moves are likely to be down rather than up. So let's unpack the concept a little bit. I think it's important to start with just a reminder of two important ideas here. And the first one is that bond prices and yields are inversely related. So I always ask people, just think of it like a seesaw. If yields go up, prices go down. If prices go down, yields go up. And we know that when interest rates rise, bonds will lose value. I mean, and we don't have to go back too far. 2021, 2022, brutal years for bonds in a rising interest rate environment. And it's, of course, the opposite. So if we expect interest rates to fall, then we would hope or we would expect bond prices to rise. So the second part of this, though, is that bonds with longer terms are generally more sensitive to interest rate movements than those with shorter terms. So they're likely to rise in value more sharply in response to declining interest rates. And that's why our listener is asking if it makes sense to move to longer bonds in this kind of environment, because you would expect that if rates do go down, the longer bonds will outperform short-term bonds over that period. Now, I don't want to get too technical, but I think it is useful to talk about a concept in fixed income called duration. Duration is a measure of how sensitive a bond or a portfolio of bonds is to changes in interest rates. And the actual calculation, unless you're Ben, is very hard to do. But the good news is you don't have to do the calculation because it can be boiled down to a single number that is easily distilled. You can just go on the website of any bond fund and it will have the duration expressed. So let's use an example here. It always helps. So let's look at the BMO Aggregate Bond Index ETF. The ticker is ZAG, very common broad market bond fund. It holds bonds of all maturities, and it's got about 30% in long bonds with terms between 10 and 30 years. And the average for the whole portfolio is right around 10 years. And if you go on this ETF's webpage, you can learn that the fund has a duration of 7.3. So what that means is that if interest rates were to fall by 1 percentage point, you should expect the ETF's price to increase by 7.3%. Okay, now let's compare that to the BMO's short-term bond ETF. The ticker is ZSB. That one is bonds only from 1 to 5 years maturity. The average is about 3 years, so quite a bit less than ZAG. And this fund has a duration of 2.7. So if interest rates were to fall by 1 percentage point, then you would expect the ETF to rise in price by about 2.7%. So when you see that, you can see why it's tempting to want to shift your bonds from shorter term to longer term, because if interest rates go down, those long-term or technically long duration bonds should be expected to outperform. But now this is where we get into the problem, because duration, it's a very useful concept when we're talking about bonds and fixed income, but it's theoretical, right? Because it describes what would happen if all interest rates moved up or down by the same amount, what we would call a parallel shift. So in other words, let's imagine the yield on 2-year, 5-year, 10-year, 20-year bonds would all need to rise or fall by the same amount in order for that duration number to work. So in other words, if all interest rates fell by 1%, then you would see that 7.3% bump in a fund like ZAG. Now, there are periods when rates will generally move in the same direction, but it's never that tidy. There's no period where all interest rates are going to move in parallel by the same magnitude, right? Now, sometimes we will see short-term rates will move, longer-term rates don't. Sometimes they both move in the same direction, but not to the same degree. And occasionally you will even see short-term rates move in one direction and long-term rates move in the opposite direction. So duration, unfortunately, as interesting as it is as a concept, it doesn't really have much predictive power when it comes to diversified bond funds that hold a mix of maturities. There's just too many variables, right? And that really is the key lesson here. And that is, it's misleading to talk about the Bank of Canada raising or lowering interest rates, plural, because they don't really have control over all interest rates. They really only directly control, the shortest of short-term rates, what they call the overnight rate. This is the rate that banks use when they lend to each other. And that rate is very important because it directly affects what you're going to pay on your variable rate mortgage, your line of credit. But it really does not directly affect the yield on 5, 10, 20-year bonds, right? There's some influence for sure, but it's not control, right? And so I thought it would be helpful to have a real world example, because as I was saying earlier, I remember getting this opposite question back when we were in an environment where everyone expected that rates were going to go up. So let's go back to 2017. The Bank of Canada had indicated that rate increases were going to be on the horizon. So at that time, this is like summer 2017, the overnight rate was only 0.5%, and it had been stuck there for 2 years. And you guys probably remember this, right? For roughly 10 years, people said interest rates have nowhere to go but up. And eventually they were right. And everyone was expecting that rates would go up. And so people were asking, well, maybe we should move from long bonds to short bonds, because if rates go up, those longer term bonds are going to get hit hard and the short term bonds are going to outperform. Well, as it turned out, the forecasts were bang on. The Bank of Canada did raise the overnight rate. In fact, it raised it 4 times in the next 12 months. So it went up from 0.5% to 1.5%. And what happened? Well, there was these 4 well-publicized rate increases. We all saw them coming, and bond funds with longer terms actually outperformed. It was the exact opposite of what people predicted. And the reason, again, is that the Bank of Canada, does not control those longer term rates. And what happened at the time was that the rates on long-term bonds barely moved, but the rates on short-term bonds went up. And so it was short-term bonds that got hit harder, right? So I looked at this. Actually, I have a friend, Kevin Prince, over at BMO ETFs. He's a good source for things like this. And he sent me some data of interest rates going back 25 years. And you could look over that period for periods of time where the yield curve was flat or inverted. So that means that short-term rates and long-term rates were either very similar, or you even had some periods, which we've had very recently, where short-term rates were higher than long-term rates. It's not a normal environment. One would expect that over time, that curve would normalize and the higher or the longer-term bonds would move to a place where their yields were higher. And what happened was, if you look back during all those periods, when the yield curve did normalize, it was not because long-term rates went up. It was because short-term rates went down. And so, in other words, if you expect short-term rates to go down, it would be reasonable to expect that long-term bonds could stay the same. At least historically, that's been the case. And so when our listener, says more rate cuts, are going to happen in the future, he's probably right about that. That isn't what we're, arguing here. But just because the Bank of Canada is lowering its own key policy rate, it doesn't necessarily follow that yields on longer term bonds will also come down. And therefore, the long-term bonds are not necessarily likely to outperform, even though that seems like a logical place to go. So I do think it's worth talking a little bit, and I'm interested in your opinion on this too, guys, is like, if we acknowledge that the central bank can influence but not directly control long-term bond rates, what else affects those bond yields, right? It seems to be it's market factors, right? It's expectations. It's people think interest rates are going to go up or down, and so therefore they do. There concerns about inflation, concerns about market volatility and safe havens that bonds might offer. So these kinds of things are market driven. And if as always, if you believe markets are mostly efficient, that stuff is probably already baked in, right? I mean, the way I like to put it, if everyone is expecting short-term rates to fall, the bond market knows that. And then the longer term rates have probably already fallen because of that expectation. So there's no opportunity here to exploit something that's already widely known.
Yep.
Yeah, I think a lot of people don't realize how big and liquid bond markets are either, right? Like we talk about stocks because they're exciting and they're flashy, and bonds, maybe people think maybe they're easier to exploit because they're just less sexy, right? Like who cares about bonds? So maybe there's pricing inefficiencies there. But the bond markets are absolutely massive. They're super, super liquid. They're super competitive. So to your point, Dan, if something like that is widely available to the point where I can literally just go on the fact sheet of the ETF and find out what the duration is, like it's right in your face. There's probably not an arbitrage opportunity available there.
Yeah. And if you want to talk about market efficiencies, I don't think there's any more efficient market than liquid bonds, right?
Mm-hmm.
Because their pricing is mathematical. I mean, obviously it is affected by market sentiment and things like this, but duration and these sorts of things are just math, right? I mean, if interest rates do go up, the bond will be adjusted by a known amount, right?
Mm-hmm.
And so there's much less room, certainly for a retail investor. There's zero room to exploit mispricings of bonds, right?
Mm-hmm.
Totally. I think another really interesting point just on the Bank of Canada idea, and should we be responding to what we think they're going to do? Fama has said, possibly in our podcast, but he's for sure said elsewhere, including in a paper, that the Fed, not the Bank of Canada, but that the Fed follows the market. It doesn't lead the market. So when the Fed's changing rates, it's doing so in response to the market. It's not telling the market what to do. So I think that further strengthens the point that you're making there.
Yeah. So, I mean, really, it's very tempting. And I always say to people, like, if you know something is coming, and we don't know rate cuts are coming, but I think we can have a fairly high level of confidence about that. And if that's the case, there's no opportunity to exploit it, right? I mean, I wish it was that simple, but I mean, it's very similar to stocks when people will talk about sort of good company equals good stock. This company, is likely to make a lot of money in the future. Therefore, it's a good stock to buy. I wish it was that simple, but alas, it is not. And so, I think that the take home here is stop trying to adjust your portfolio based on forecasts, because the market has already incorporated all of these into the prices. And so your job then as an investor when you're building a fixed income portfolio is match it to your risk tolerance and to your time horizon. And, longer term bonds versus shorter term bonds, those are important decisions. If you're holding your bonds in an RSP, you don't plan to make withdrawals for 10 or more years, include a fund that has longer term bonds, right? If you are retired and you're drawing down your portfolio now and you would prefer less volatility in your fixed income, hold shorter term bonds. Just don't try to switch back and forth, because that's where you run into trouble. And, build a portfolio that, makes sense for you and your situation, not for what you think the market conditions are going to be.
Timeless advice. Great stuff,
Awesome.
Dan.
Yeah, great question from your reader or client.